One of the richest people in modern history recently saw his net worth estimated in the trillions for the first time, at least on paper, and depending on the year you look at, he has still managed to pay close to nothing in federal income tax. Not because he broke the law, not because an accountant found some clever hidden trick buried deep in the tax code. He did it using a method so simple that a teenager could understand the mechanics in about 30 seconds, and so quiet that most people who use it never call it anything at all. The people who study it for a living have started calling it buy, borrow, die. Picture two people standing next to each other at the exact same net worth, on the exact same day. One of them earned it through a salary, bonus after bonus, direct deposit after direct deposit, and every single dollar got taxed the moment it landed. The other built the same fortune by watching a pile of stock quietly grow in value, year after year, without ever selling a single share of it. On paper, they are equally rich. On a tax return, they are not remotely the same person. One of them has been handing a large chunk of every dollar to the government as it arrived. The other has arranged his entire financial life so that almost nothing ever technically arrives at all. Here's the whole idea in one sentence, and everything after this is just the explanation. For most investors, if you never sell an asset, you never owe tax on it, and if you need cash, you borrow against the asset instead of selling it, because a loan is not treated as income as long as you're on the hook to pay it back. That single sentence, followed with enough discipline for enough decades, is the quiet rule that separates how ordinary people relate to their money from how billionaires relate to theirs. Most people are taught a straight line. Earn money, get taxed on it, spend what's left. Billionaires, or at least the ones who actually keep their fortunes, run something closer to a loop. Buy an asset that grows. Borrow against the growth instead of selling it. Spend the loan. Let the asset keep growing to cover the debt. Repeat, for as long as the asset keeps appreciating faster than the interest on the loan compounds. Buy. That part sounds obvious, but the specific thing being bought matters enormously. Wealthy households overwhelmingly hold their fortunes in things that appreciate without generating a taxable event every year. Company stock that pays no dividend. Real estate. Concentrated ownership stakes in businesses they built themselves. None of that produces a tax bill just by sitting there and going up in value. A regular paycheck is taxed the moment it lands in a bank account. A stock portfolio that triples in value over a decade owes nothing at all, for as long as nobody sells it. This is also why so many billionaire founders famously draw almost nothing in salary. Bezos paid himself an Amazon salary of around $80,000 a year for years, a figure smaller than plenty of mid-level managers earn at ordinary companies, not because he needed to live modestly, but because a salary is taxed immediately, and a rising stock price is not. The low salary was never frugality. It was architecture. Borrow. This is the part almost nobody explains clearly, and it is the part that actually does the work. Once an asset like that has real verifiable value, a bank will lend against it, usually at a fairly low interest rate because the loan is secured by something the bank considers safe collateral. A brokerage account holding a large, diversified stock position can typically borrow up to somewhere around half its value without much trouble. A concentrated position in a single company's stock, the kind founders and executives tend to hold, usually supports a smaller percentage because a bank does not want to be left holding the bag if that one company has a terrible year. Either way, the mechanism is identical to a mortgage, just applied to a brokerage account instead of a house. And here is the detail that makes the entire strategy work. Under the tax code, a loan generally is not treated as income. You can borrow $10 million against a stock portfolio worth $100 million and legally owe $0 of tax on that $10 million. Because as far as the IRS is concerned, nothing was ever sold and nothing was ever earned. It was borrowed, and money you owe back to a lender is not the same thing as money you've earned. There's one number that ought to genuinely shock you, and it did not come from a projection or an estimate. It came from actual tax filings. In 2021, the investigative newsroom ProPublica obtained a trove of confidential IRS records covering thousands of the wealthiest people in the country and used it to calculate something they called a true tax rate, comparing how much someone actually paid the IRS each year against how much their overall wealth actually grew in that same period. The 25 richest Americans saw their combined net worth rise by roughly $401 billion over a 5-year stretch. Over that same period, they paid a combined $13.6 billion in federal income tax. Run that math, and their true tax rate worked out to about 3.4%. A median American household, by comparison, pays close to 14%. That is the entire story in two numbers. Everything else is just detail, and the detail is almost stranger than the headline number. Warren Buffett, a man who has publicly and repeatedly argued that people like him should be taxed more, posted a true tax rate of about 0.1% over that same window because Berkshire Hathaway famously does not pay a dividend. His wealth grows entirely through a rising stock price, and a rising stock price generates no taxable income unless he actually sells shares, which he mostly does not. Jeff Bezos paid zero federal income tax in two separate years covered by those records, years in which his fortune still grew by billions. Elon Musk paid zero in one of those years too. None of it was illegal. All of it came down to the same quiet mechanic. Income gets taxed, growth, left unsold, does not. Borrowing against assets is not limited to a stock portfolio either, and real estate is where an enormous amount of this strategy quietly plays out, often in ways that have nothing to do with Silicon Valley or Wall Street at all. An investor who owns an apartment building that has doubled in value over 10 years does not need to sell the building to access that gain. A cash-out refinance lets them pull a large chunk of that appreciation out in cash, tax-free, because refinancing is still just another form of borrowing, while the investor keeps collecting rent on the same property and keeps depreciating it on paper for tax purposes at the same time. That last detail is almost stranger than the borrowing itself. Tax law allows real estate owners to deduct a portion of a building's value against their income every single year, treating the structure as though it is wearing out, even in years when the building's actual market value is climbing. It is entirely possible and extremely common among real estate investors at scale to show a loss for tax purposes in the very same year a property's true value increased by millions of dollars, and then to refinance that same property and pull the increase out as a loan. Sell nothing. Owe nothing. Walk away with cash. And the surprising part is, none of this required either man to live like a monk. Bezos was buying yachts and funding a space company during years he legally owed the government nothing. That is not a contradiction once you understand the loop. The lifestyle was funded by borrowing, not by selling, and borrowing does not show up as income no matter how many zeros are attached to it. There's one problem with stopping the story here, though, because borrowing alone only delays a tax bill. It does not erase it, not on its own. That's where the final piece of the loop comes in. The one that turns a clever delay into something closer to permanent. Die. It sounds morbid to put it that bluntly, but it is the exact word tax professionals use because it describes the mechanism precisely. Under a provision of the tax code known as Section 1014, when someone inherits an asset, the asset's cost basis resets to its market value on the date of the original owner's death. In plain terms, imagine a founder bought stock decades ago for a few $1,000,000, watched it grow into a few billion, and never sold a share of it while alive, borrowing against it the entire time to fund every yacht and every home along the way. When that founder dies, their heirs inherit the stock at its full current value, not the original purchase price. If the heirs turn around and sell it the very next day, there is no capital gains tax owed at all, because as far as the tax code is concerned, all of that decades worth of growth simply never happened. The outstanding loans get paid off using some of the newly stepped up assets, and whatever is left passes to the next generation completely clean. Put actual numbers on that, and the scale of it becomes obvious. Say a building was bought for $1 million 20 years ago and is worth $8 million today. Sell it while alive, and roughly $7 million of gain gets taxed. Die still holding it, and the heirs inherit it, valued at $8 million, the full current price, with zero capital gains tax attached to that appreciation. They can sell it the following week and owe no capital gains on the sale at all. $7 million of capital gain, the kind that would normally be subject to long-term capital gains tax, simply disappears from that particular ledger the moment ownership passes from one generation to the next. That is not the whole tax picture, since a large enough estate can still owe a separate federal estate tax on its way to the next generation, and plenty of wealthy families spend heavily on lawyers specifically to plan around that. But the capital gains bill on decades of growth, the part that would normally follow an asset every time it changes hands, is the piece that gets wiped clean. Buy an asset that never has to be sold. Borrow against it instead of selling, so the growth is never taxed as income. Die still holding it, so most of that growth is never taxed as a capital gain either. 3 words, and an entire fortune can move through decades and even generations while the capital gains bill on almost all of it quietly disappears. This is not some obscure trick available only to the ultra-wealthy on paper, but out of reach in practice. Elon Musk used exactly this mechanism in a very public, very well-documented way in 2022. When he needed roughly $12.5 billion to help fund the purchase of Twitter, he did not simply sell that amount of Tesla stock outright and trigger a massive capital gains bill. He initially sought to finance a large share of it with loans secured by Tesla stock instead. The structure was a margin loan, pledging Tesla shares as collateral. It let him access enormous liquidity without an equivalent taxable event. Reach for the loan before reaching for the sale. That was the loop playing out in public at a scale most people never see up close. It is worth being honest about how it played out afterward, though. When Tesla's stock later fell sharply, Musk did end up selling billions of dollars of shares anyway to reduce that borrowed exposure. Even a well-capitalized version of this strategy still has to respect the math of the collateral sitting underneath it. He was not inventing anything new either. Cable billionaire John Malone has used stock-backed borrowing for years to fund acquisitions without ever needing to sell down his core holdings. It is common enough among people at this level of wealth that the largest private banks in the world built entire divisions specifically to originate these loans, competing with each other over interest rates, loan-to-value ratios, and how quickly they can wire 9 figures against a stock portfolio used as collateral. A relationship manager at one of these banks is not selling a savings account. They are selling access to a client's own wealth, structured so the client never technically has to touch it. For the bank, it is close to ideal business. The loan is secured by liquid, publicly traded collateral. The interest income is steady, and the client, statistically, is exactly the kind of borrower who never misses a payment, because missing a payment on a loan secured by a fortune is not something that tends to happen by accident. Play that loop forward across an actual career, and it stops sounding abstract. A founder takes a company public in their 30s, holding a huge stake worth, say, $200 million on paper. They do not sell it, because selling triggers a capital gains bill and because selling signals to the market that the founder might not believe in their own company anymore. Instead, they take out a modest loan against a small slice of that stake to buy a house, fund a new venture, or simply live comfortably, paying a manageable interest rate on the loan while the underlying stock, ideally, keeps climbing. A decade later, the stake is worth $1 billion. The original loan has long since been repaid or refinanced into a larger one, always kept well below the value of the collateral backing it. Another decade after that, the founder is worth several billion, has borrowed and repaid multiple times along the way, and has never once triggered a capital gains tax on the growth because not a single share was ever actually sold. When they eventually die, decades from that first public offering, their heirs inherit the stock at whatever it is worth on that final day, wipe out every dollar of growth from a tax standpoint in an instant, sell enough to pay off any remaining loans, and keep the rest completely clean. This is where the story turns and starts to feel a little unfair because it flips almost everything you have ever been taught about debt. For most people, debt is the enemy. A credit card charging 20% interest on a balance that never quite gets paid down. A student loan that follows someone into their 40s. Debt, for most households, is what happens when income falls short of expenses, and it is treated correctly as a warning sign. For a billionaire running this loop, debt is not a warning sign at all. It is the entire point. The interest rate on a loan secured by a diversified stock portfolio is typically a fraction of what a consumer pays on a credit card, precisely because the collateral is so much safer from the bank's perspective. The same word, debt, describes two completely different financial experiences depending on which side of this system you are standing on. For one group, it is a trap that compounds against them. For the other, it is a tool that lets them compound in peace. That's only half the picture, though, because it explains why this works so well for a founder, but is basically unavailable to someone earning a normal salary. Access to this kind of lending is not primarily about being rich in some abstract sense. It is about being rich in a specific bank-friendly way. Lenders offering these large credit lines generally require substantial, liquid, verifiable assets, strong credit, and high income on top of it all, because the entire arrangement depends on the bank trusting that the collateral will hold its value. A retiree with a paid-off house and a modest retirement account technically owns appreciating assets too, but a bank is not going to extend an 8-figure credit line against a $400,000 home. The buy, borrow, die loop is available in miniature to plenty of ordinary homeowners through something as familiar as a home equity line of credit, which lets you borrow against the rising value of your house without selling it and without triggering a tax bill on the appreciation. The mechanism is identical. The scale is what changes everything. But this is where the story stops being a clean success and turns into a warning, because the same silent rule that quietly built some of the largest fortunes on Earth has also quietly destroyed a few of them, and the difference between the two outcomes usually comes down to a single word: discipline. In March of 2021, a relatively unknown investor named Bill Hwang was running a family office called Archegos Capital Management, and he had taken this exact strategy, borrowing heavily against appreciating positions, and pushed it to an extreme almost nobody outside his small circle of banks understood at the time. His fund had grown from roughly $1.5 billion to somewhere near $36 billion in barely a year, not through diversified patient buying, but through concentrated bets on a handful of stocks, amplified with borrowed money until the fund's real market exposure ballooned past $160 billion. When one of his largest holdings dropped sharply after a stock offering announcement, the banks issued margin calls, demanding Hwang post more collateral to cover the falling value of his positions. He could not. Within 48 hours, roughly $20 billion of personal wealth was gone, and banks around the world scrambled to dump his collateral before the losses spread further, ultimately absorbing more than $10 billion in combined losses themselves. Hwang was later convicted on multiple counts of fraud and market manipulation. The lesson sitting underneath that collapse is not that borrowing against assets is dangerous in itself. It is that the version of this strategy which quietly builds generational wealth and the version that detonates in 48 hours are separated by exactly one variable: how much you borrow relative to what you actually hold, and how honestly that ratio gets reported to the people lending you the money. The disciplined version keeps loans well below the level that would trigger a margin call even in a serious downturn, spreads that borrowing across diversified holdings instead of one concentrated bet, and treats the interest payments as a permanent, manageable cost of never having to sell. The reckless version borrows against a single volatile position, hides how leveraged it actually is, and gambles that the market will never move against it hard enough to matter. One of those approaches is how a fortune quietly compounds for 50 years. The other is how $20 billion disappears before breakfast. There's also a real debate, even among people who study this closely, about how much this strategy actually explains. And it is worth pausing on because it complicates the tidy version of the story. Some tax economists have pushed back on the popular version of the buy, borrow, die narrative pointing out that the more common reason billionaires pay so little tax is simpler and less dramatic than a clever borrowing scheme. Researchers at the University of Michigan and Yale have argued that the sheer volume of large-scale borrowing the theory implies does not actually show up in the data the way you would expect if it were the primary engine behind billionaire tax avoidance. Many of these fortunes simply never generate much taxable income in the first place because their companies do not pay dividends and their owners are not required to sell stock just to prove their wealth is real. Borrowing against assets to fund a lifestyle is real and well documented, and Musk's own margin loan against Tesla stock proves it happens at enormous scale. But for most ultra-wealthy people, the bigger and quieter tax advantage is simply that unrealized gains are not taxed at all. Borrowing or not, which means even someone who never takes out a single loan in their life can still watch their fortune compound for decades while paying almost nothing on the growth. The three-word slogan is catchy. The underlying truth is a little less cinematic. It is not one dramatic loophole hiding in the fine print. It is the entire architecture of how investment income gets treated differently from wage income, running quietly in the background of every year these fortunes exist, with borrowing as one particularly visible tool inside a much larger structure, which is exactly why this has become a live political fight rather than a settled piece of tax trivia. Lawmakers, including Senator Ron Wyden, have proposed a billionaire's income tax that would tax unrealized gains directly for the ultra-wealthy every year, whether or not any stock was ever sold, closing the loop before death ever gets the chance to erase it. Senators Chris Van Hollen, Bernie Sanders, and Elizabeth Warren have separately pushed to repeal the stepped-up basis rule entirely, the exact provision that makes the die step of this strategy work. At the state level, California Governor Gavin Newsom has publicly raised the idea of restricting this kind of tax avoidance within the state, part of a broader wave of discussion among state officials about limiting strategies like buy, borrow, die, with figures like Musk and Malone frequently cited as examples of the kind of legal but corrosive tax avoidance the current system was never designed to allow at this scale. None of these proposals have become law yet, and each one faces the same basic obstacle. Taxing unrealized gains means asking someone to pay cash on paper wealth they have not converted into cash, which raises genuine, unresolved questions about how you value a private business or a concentrated stock position that has never actually been sold, and what happens if that value falls right after the tax bill was calculated. Every one of these proposals is aimed at the exact same mechanism, though because once you understand how the loop works, it becomes obvious that closing off any single step, taxing the borrowing, taxing the unrealized gain, or eliminating the step-up at death would be enough to break it entirely. Until one of those proposals actually passes, though, the loop keeps running exactly the way it always has. That's the silent rule. Not because it's hidden, but because almost nobody bothers to explain it. The next time you hear that some founder took out a massive loan instead of just cashing out and paying off the government, do not assume he needed the money. In most cases, that loan is not a sign of financial pressure at all. It is the entire strategy, working exactly as designed. And the next time somebody tells you the wealthy got rich by taking bigger risks than everyone else, remember Bill Hwang, and remember that the real risk was never the debt itself. The risk was believing the loop would keep working without ever having to prove it could survive a bad week. For the ones who get it right, the debt is never a burden. It is the quiet machine sitting underneath a fortune that was never really sold. It was only ever borrowed against one generation at a time.